Hello and welcome to IG's Trading the Markets podcast. This time last year, the markets were recovering from the lows after the pandemic-driven sell-off, but the last 12 months have seen an impressive recovery. So with US indices now back up to all-time highs, should we be bracing for a potential correction? With me to discuss the risks to the stock market and how best to prepare is Phil Toews. He's the CEO at Toews Asset Management. Phil, good to speak to you. Now, I know you've had years of backtesting and success in bear markets, and that's led you to develop this risk management strategy, which allows you to participate in rising markets, but also protect against the risk of a sudden or even long-term downturn. And that's really the big thing for investors, isn't it? Trying to make sure that you are still in the market if we continue to see more all-time highs, but at the same time, just being prepared in case it moves the other way and not getting caught off guard. So just first and foremost, I wanted to ask you about your thoughts on current valuations. Do you think the market is overvalued, or is there more potential for upside?
So we think it is overvalued by just typical measures like price earnings on broad indices like the S&P 500. Where it really gets interesting is if you start looking beyond just these broad indices and things like NASDAQ stocks and then innovator funds, where you're more in a range of 140 times trailing earnings. And so if you look even beyond that at things, a phenomenon like NFTs, some of these things look like bubbles that are not only comparable to the internet bubble that we saw 20 years ago, but we're making comparisons right now to tulip mania. I mean, if you're willing to spend $69 million on one JPEG file, how different is that than spending a small fortune on a tulip bulb? So, with that said, to answer the second part of your question, we haven't seen the kind of euphoric moves in the stock market that we saw in the internet bubble. So I think it's maybe a 50-50 chance right now that either we start a leg down or we continue up and we could power up for another 6 months or longer. And then ultimately, it's a foregone conclusion. But I think we could go either way right now. And as you framed at the beginning of this segment, the key is to be positioned for either.
Yeah, so I guess one of the questions really is, what could it be that prompts that correction? Is it fears about inflation? We've seen that spook some of the growth stocks in the first quarter. Could it be the potential from the Fed signaling some tightening, possibly some weaker data, a slower than anticipated recovery? What are your thoughts there? What are the big risks?
One of my colleagues recently referred to this as being like when you were a kid and you had a friend chewing bubble gum and they've got this giant bubble in front of them and it just keeps getting bigger and bigger. And so something is going to happen. So look back to similar situations. If you go to the internet bubble burst, there wasn't really any specific thing that happened that you could point to that caused it, other than just some of these internet stocks collapsing from their own weight. But right, I mean, it's fascinating to look at the Fed because we have seen several declines over the past 2 years. I think we would point to the decline in the fourth quarter of 2018, as well as the recent decline in tech stocks, as being caused by interest rate rises. And so we've gotten used to, since the financial crisis, the Fed coming in and more or less saving the market. I'm not sure we can rely on that now, primarily because the economy appears to be set on a course of growth. If we're looking at a potential GDP growth, at least in the United States, of as high as 5% annual, what that means is that if the stock market falls, and even if it enters into a correction or more, I don't think the Fed, as long as the economy is on a course to grow, is going to step in as it has in the past. So if investors realize that, oh, wait, that part of this equation of a never-ending bull market is missing, I think that could potentially accelerate the decline if we see it begin.
So we're just about to kick off first quarter earnings season in the United States. In fact, it's just beginning. We've already had numbers from some of the big banks like JP Morgan and Goldman Sachs, which beat expectations. What are your sort of overall expectations for this quarter's numbers, and what might that mean for US indices?
So I think it would allow the stock market bull market to continue. And yeah, so we have expectations that earnings are going to come in pretty decently. And that is a positive for the markets. But as we were discussing earlier, they're priced in such a way that even if we do meet expectations or exceed them, we kind of need perfection in performance, not just this quarter, but in quarters that are coming to support valuations. So the way we look at it is, even if we meet rosy expectations for the next 2 years, you still wouldn't be anywhere near average valuation, so you'd still be overvalued. And so, if you look at forward earnings now on the S&P 500, that there's a prognosis, if you look at history, for basically zero returns over the next 5 years. So we've got a lot of necessarily even acceleration from expectations that we need in earnings to justify current valuations.
So tell us a bit about your all-weather approach. How is it that you make sure that you're able to participate in that upside while also shielding to an extent from the risks of declines?
We don't have an expertise at choosing which stocks to be in. The entire focus of our asset management firm is on creating hedge strategies. And what those strategies are trying to do is participate in indices when markets are moving higher, but to exit markets when they begin to move lower. And we do that either through making tactical moves into fixed income or cash instruments, or with options hedging strategies. And the way we recommend that investors position these types of funds is to allocate around 50% of your portfolio into just index funds that are riding up and down with the market. But if you take half of your equity portfolio and put it in something like these hedged strategies or funds, what that allows you to do is then, if the markets do continue higher, to remain relatively fully invested. But if they turn lower, with 50% of the portfolio potentially exit and be on the sidelines. And that part of the portfolio can actually benefit from a decline, because let's say the market begins to move down and this fund moves to the sidelines, especially if it's a big decline down of if as much as 50% or more, that fund may be poised to re-enter and actually benefit from the decline. So we refer to this as a behavioral portfolio. It allows investors to have maybe not be as concerned about declines and not have to make the decision whether they fully are staying in the market or whether they leave.
Yeah, it's really interesting, and it's sort of allowing for emotions to be incorporated into your portfolio, in the sense that you're not letting your emotions run away with your decisions. So, in
Exactly.
terms of actual opportunities sector-wise, I mean, there's been so much talk about this shift away from growth and towards value this year as the economy starts to recover from the COVID crisis. Where are the opportunities, do you think?
Well, a lot of the reflation trade has already happened. If you look at something like airlines are back about where they were before the pandemic. Similar with the case with hospitality stocks, and those would be the first intuitive places that you would look. We would look right now towards small and mid allocations above large cap growth, and we've seen a strong relative performance advantage for those categories so far this year. Definitely include a portion of emerging market stocks in your equity portfolio, because the valuations are just so much more favorable there than they are in a lot of developed country stocks, and including Europe and the US.
What about the tech sector? Do you think there's more room to run there?
Not really. It's interesting. It was fascinating to watch during the pandemic-led decline that what was traditionally more risky, thought of as a more risky asset class, which are tech stocks, did much better. However, historically, tech stocks tend to be more highly valued, and therefore they tend to lead the market lower. And just as we saw over the past couple of months when we had a brief downturn, we think that that'll happen again. So once this bubble finally pops, we think tech will lead lower. So I wouldn't do an outweight to tech, even though some of these ideas like innovator stocks and things like that look compelling right now.
And what about geographically speaking? I mean, you mentioned already the opportunities that you see in emerging markets. Is that your sort of strongest long-term call?
Yeah. So in our own portfolios, we don't have emerging markets exposure. We're typically providing access to developed country stocks, both either internationally or in the US, and those indices with hedging strategies in place. But if you just look at valuations, really anyone, looking at parts of Asia that are continuing to have decent growth, but have much better pricing of their stocks, those are the places that we would look. And even just broadly diversified emerging market funds would not be a bad bet right now.
And very finally, if you were to look into your crystal ball, where do you think stocks might end the year? A tricky one.
you know, I'm as vulnerable to behavioral biases as everyone else, and I'm almost betting that this bull market runs for a while longer. because we haven't seen the really euphoric purchasing of stocks, at least reflected in terms of pricing. So we would guess that this would continue for a while. Does it last through the end of the year? I just don't know. So it's hard for me to, as unsatisfying as that is, Victoria, it's hard for me to make a call for year end. But I would guess we'd have at least another 3 months of this rally. But what I would say is within the next 18 months, I think we'll have a significant leg down.
Last year, we had a sort of once in a decade move lower, something that we hadn't really seen since the financial crisis. But typically, we see sort of 10% corrections every 1 to 2 years. So the next correction, how big is it going to be?
So if you look back at, we were managing assets in the same strategies back in the late 90s. And so on that path higher, which was, among the most impressive bull markets over the last 50 years, there were a number of times when markets would fall 10% or even 20%, and then the rally would continue. By the time we got to 1999, markets became increasingly volatile. So you could have markets moving as much as 3 or 4% per day while we were still in this bull market. So volatility really picked up. If this bull market continues, I think you could see more of that. You could see some of these big moves where you could have a correction in the course of a couple of days, and then it just continues into a bull market. And during that kind of an environment, what people learn is that downturns are buying opportunities, and that works up until it doesn't. So if the bull market continues, I would expect a lot of that kind of volatility.
Yeah, and I think that's basically why we had such a sharp correction last year and such a speedy recovery.
Yeah, that's the real story from a market historical perspective. Last year is that if you weren't watching your statements for a month, you really didn't even know what happened. And so and for relatively new investors, they think like, oh well, down markets are nothing. As long as you can just hold in there for a month or so, you're fine. And frankly, even the financial crisis was, by some historical standards, brief because the Fed was so effective and the government was so effective at helping bring us out of that. One of the things we wrote in a commentary that we put out last week was that we used to have boom bust cycles where the bust was a depression. But due to the fact that the Fed and the federal government has put in so much stimulus, now we seem to have boom cycles with brief capital market crises in between. And so ultimately, we don't think that'll happen. We think bust will actually be some kind of a longer term economic event. So it's not always brief. Some of these longer term declines can happen. And frankly, it's only when you add long duration declines to high percentage declines that most investors are affected. If you have something that happens like we saw last year, most investors don't really realize any negative effects from it.
All right, Phil, it's been great to chat to you. Thank you so much for sharing all your insights.
It's been awesome. Thanks.
That was Phil Toews, the CEO at Toews Asset Management. I'm Victoria Scholar, and thank you so much for listening to our podcast, IG's Trading the Markets. For more videos like these, make sure to follow us on Twitter. We're at IGCom, and you can subscribe to our YouTube channel, IG UK.